Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, this is the second installment of our two-part special on planning and investing for retirement and deriving regular income. And in today's episode, Dhirendra Kumar will explain some of the proven methods to generate regular retirement income. Welcome, Dhirendra.
Thank you.
Now, let's start today's episode with, say someone who's already in the firefighting mode. So they have a limited saving or investment, and the calculation tells them that they need much more than what they already have. So in such a scenario, what should one do?
Not much to do. And that's the bad news. The bad news is because most of the thing that you need to do for a peaceful retirement has to be done many years much before you retire. Something can be done, but it will not be significant. In fact, the bitter pill is that you just might have to work for a little longer. You will have to reduce your expenses. The first thing you have to really think in terms of do the basic arithmetic. How much money do you need? And how much money do you have? And the money that you need, if it is going to be more than 6% of your accumulation, 6% can be derived, but 6% is just not enough, simply because if you consume all the 6%, then your money will remain constant. And if the money remains constant, then 2 years down the line, you will not only need 50,000, you will need 60,000 by, simply because of inflation. And that is why there is, in your retirement, you need some buffer so that you are able to withdraw or, you are able to derive an income which is conservative and good enough. Based on that conservative estimate, it is good enough to support your income needs. At the same time, there is something left over of the appreciation which will keep, growing your capital, which can support the larger income requirement in future. So anything where your income requirement is more than 6%, you have to really worry about it. And the way to deal with it is, you have to buy some time by either working so that you continue working. You don't need it tomorrow. So if you get 3 years time, 2 years time, that will be very easy. But it entirely depends on what is the gap? What is the gap in the 6%? Because if you don't do that, you will not get an opportunity to invest in equity. Investing in equity amounts to taking risk, not impairment risk, but it will be volatile and you can't derive. So having a higher allocation to equity is important, and that amounts to taking risk, and you can't do it substantially if you are going to derive income on a regular basis.
All right, now moving on from there, how to combine guaranteed income saving schemes with equity to derive income in retirement?
Any long-term investment portfolio must have some fixed income. And that fixed income component is a function of, your risk tolerance, or how come, as I was saying in the earlier example, that if you need 50,000 rupees a month, which is 6 lakh rupees a year, and if you have 1 crore, that 1 crore should be invested in substantially into equity, moderately into fixed income, and follow that 3-bucket principle, that the money that you need in the first year, 50,000 rupees a month, or maybe in 2 years, 12 lakh rupee, put it in a liquid fund and do a 50,000 rupee withdrawal plan. So you are completely safeguarded from your remaining money, which is, 1 crore minus 12 lakh rupees. That is the money which can be invested in long-term assets with a fixed income allocation, maybe 25% fixed income, 75% equity. And that 25% fixed income can be invested in guaranteed return products, which will give you guaranteed returns, and that is the senior citizen savings scheme or the post office MIP. And club with this any pension plan that you have. If you work for the government, then you will be getting some pension. You want some supplementary income, that makes your life very easy. So you will have to total up everything that you can bank upon. And those guaranteed income schemes are normally government sponsored. They are absolutely safe. There is no uncertainty about there's no likelihood of a credit default. There is no likelihood of any delay in payment. It is almost like lending money to the government. And you should create a hierarchy of 2-3 things. One is that your PPF accumulation, that could be a very desirable thing. Second is the senior citizen savings scheme. Third is, post office MIP. They are absolutely safe, and consider them as your fixed income allocation.
Okay, you mentioned PPF. So, should one be, saving in PPF? Should one be while he's earning?
I actually, face a lot of brickbats on this. I actually give advice which is very contradictory. I say that if you are a long-term investor, don't invest in PPF, because PPF means investing 1.5 lakh rupees in a fixed income avenue, which will give you guaranteed income. And if you do this 1.5 lakh rupees for 15 years, your money in any average equity fund or little above average equity fund or in an index fund will be almost 2.5 times more than what you will accumulate in PPF, which is quite crazy. And for a person who is very savings oriented, he's disciplined and he's doing it, this is not a good idea. If you're disciplined enough to do your 1.5 lakh rupees annual investment spread over every month, over the next 15 years, do your equity fund SIP. You will have 2.5 times more. But if you somehow have done this PPF, you are not aware of this, and you are left with some corpus, consider that, retain that, keep your PPF account live, derive that income, simply because the PPF is the only vehicle in this country where the return that you get is completely tax-free. And in fact, the only other income that you get which is completely tax-free is agriculture. So where you have to work, this is something where your money is working in a manner which is very safe, and all your income is tax-free. So for that tax efficiency of this income that you derive, assuming that you have 30 lakh rupee, 40 lakh rupee worth of accumulation, and if you're deriving this PPF income, that is your tax-free income. It is almost like having 20% more or 25% more, depending on the tax bracket you fall in.
All right. Now, if someone has 1 crore rupees as his retirement corpus and they don't want to assume any risk at all, what should be their strategy?
Most people are conservative, and more so in their retirement, and understandably so, because once you stop getting your income, every reason why you should be very cautious. But at the same time, if you have 1 crore of rupees, first is that it is entirely it is a function of how much money do you need. If you need 25,000 rupees a month, then you can be very conservative. But if you need 50,000 rupees a month, you need to be little aggressive with because if your expectation is to have 50,000 rupees today, your need will be 65,000 rupees 3 years or 5 years from now. And for that, your capital needs to grow. For your capital to grow, besides supporting you with this income requirement, it must be invested in equity. So you wanting to be conservative or you wanting to be aggressive is not a matter of your choice. You can only assume that risk in a measured way, in a calculated way, and understand the risk better, because it's not a choice. If you need 50,000 rupees a month today, you have to necessarily invest about 50% into equity for you to be assured that, okay, your capital will keep growing in a manner that it can support income. If you need 25,000, maybe you can do without it, because your money will earn in a risk-free manner 6-7%. You will consume only 5% or 6%, and it is earning little over 7%. So the differential will actually keep supporting you. But I would say that every investor in his retirement should understand that there is a risk, and you have to understand how to navigate that risk, how to conduct yourself, how to behave yourself so that you are able to de-risk yourself from the madness of the market. How not to, and the only way of educating yourself or de-risking yourself or learning it well is to invest. It's a kind of swimming. You can't really do it in the classroom. You have to jump into it, and you can jump into it and learn about it only when you have the time. Once you retire, you can't learn. So I think when you approach your retirement 10 years before that, start investing in equity. Do your SIP, choose a flexi cap fund, do it for 5 years. That is the only learning which you need to do. Without that, all this, or me talking to our audience or, to value research users and going by the scale of questions that we get, going by the anxiety that it causes, saving for retirement and living with dignity in retirement is one of the biggest, worries for most investors. And what needs to be done about this is a pretty simple thing.
All right. Now, you mentioned the three bucket strategy a while back. Can you please elaborate on what exactly is that three bucket strategy?
Oh, this three bucket strategy is, giving some framework, giving a method to people that how to divide their money based on their needs. Everybody should divide his money depending on his need, because your needs are the primary driver for the way you should be investing. And that is, if you need your money in the next 3 years, or you need your money in the next 1 year, that money should be invested differently. The money that you need anywhere between 3 to 5 years should be invested differently. And the money which you should be invested for 5 years and beyond, you might need it after 5 years, you may not need it after 5 years, that needs to be invested differently. Because this money within the next 3 years should never be invested in equity. It should be invested in a manner that you can withdraw it anytime. In fact, if you need that money in any time between couple of weeks to couple of months, maybe don't invest it. Let it lie in the savings bank account. It will keep earning 4, 5, 6% depending on your bank. Maybe do your deposit shopping, because you'll be so much more comfortable. You don't have to move your money around. Else, invest in a liquid fund which is reasonably safe. You are not exposed to any substantial risk. And money between 3 to 5 years, invest in a short-term debt fund. And money beyond 5 years, that should be invested in a tax-saving fund if it will save you tax, or a flexi-cap fund. And don't do anything else. And never invest lump sum. Even if you have somehow got a bonanza, you're sitting on 10 lakh rupees, never invest that money at one go. Howsoever attractive the market looks, or howsoever tempting the market looks, spread that money over something like 15 months, 18 months, because reducing the risk of catching a market high is a very important milestone, or should be a goal for most investors, because it is not the market is dangerous. It is the way you behave when the market crumbles once in a while, and it will keep doing it, and it always happens. That is how you have to configure yourself. It's almost like wearing a helmet.
Okay.
Or, using the seat belt.
All right. Well, that's all we have for you in today's episode. But since we're getting a lot of questions on retirement, the next episode we'll dedicate it to taking up your questions and answering them. Though we won't be able to answer all of them, we'll pick up some of the frequently asked ones. So that's all we have. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.